As a small business owner, your corporation might generate more income than what you need for your daily operations or personal expenses. So what you do with this surplus income is crucial for your financial future. You basically have two main options. You keep the funds inside the corporation, or you withdraw and invest personally. So today, we're going to go through these two scenarios. Do you take the money out of the corporation and invest it in, say, your RRSP, or do you keep it inside the corp and invest there? So hi, my name is Laurent Meunier, and I'm a partner and advisor at Safe Pacific Financial here in Vancouver. And we've been advising Canadian business owners and helping them to protect and to grow their wealth for more than a decade. Let's get into it. So the main research and the numbers that I'm going to be using in today's video are from a really good Sun Life article, and we'll include that into the show notes below. You can download the whole thing. The article is about RRSPs and the benefit to Canadian business owners. And the TLDR is that for a lot of business owners, maximizing the contributions to your RRSP is actually a smart strategy, and especially if you've got a long time horizon. The strategy also gets better now that we've had this 2024 federal budget change, which included the capital gains inclusion rate that was going up since June in 2024. And basically, since this new 2024 federal budget, it made RRSPs more valuable as a tax-efficient savings vehicle. So now you first have to understand corporate versus personal tax strategy. So many business owners in Canada, they will benefit from a low tax rate on their active business income. And so this is called the general rate. And across the different provinces, your combined federal and provincial general rate is anywhere from 23 to 31%. If you're a small business, you get the small business deduction, which reduces your tax rate on the first $500,000 of net active business income. And so across the different provinces, this is anywhere from 9 to 12.2% on the first $500,000. Now contrast this to your personal tax rate, which is usually higher than your corporate active business tax rate, right? In 2024, the highest combined marginal tax across all the different provinces is around 50%. So huge tax number on the personal side. When you get dividend income, that's taxed at a lower rate because you've got a corporate tax that you already paid. And so in Canada, you have what's called an eligible dividend. When those ones will get paid anywhere from 28 to 46% tax when you're paying the general business rate in your corporation. And you'll pay 37 to 49% on your non-eligible dividends if you're in the small business tax rate. So now, when you first look at it, the lower corporate tax looks like a good tax deferral advantage by keeping the money inside your corporation. But this depends on a bunch of different factors. So for instance, the RRSP may initially allow for more money to be invested compared to a corporation. And your ultimate outcome, still, it depends on your after-tax income when you withdraw the funds to use yourself personally. So some of the key factors to consider for your tax optimization are, number one, it's your corporation's initial tax rate. Are you paying the general rate or the small business rate? Obviously, the small business rate is much lower. Number two, it's whether your tax bracket is going to change between now when you invest and later when you withdraw. And then number three, also, like, what are you invested in? What type of income are you generating? Are you getting interest income or dividends or capital gains, or are you getting deferred gains? So depending on what you invest in, it's going to depend on kind of what income you receive. And then number four is how long are you investing for? What's your time horizon? When do you need the money? And also, like, what do you need that money for? So these are all important factors to consider as a small business owner so that you can make, obviously, the best informed decisions, and you want to maximize your after-tax return to achieve your long-term goals, right? So you want the most money in your pocket after you take it out and you want to spend it. So now let's get into the RRSP versus corporate. And when it comes to investing this amount, right? So it's your surplus amount. As a small business owner in Canada, you have the option to put the money in your RRSP, or you keep the money in your corporation or your holding company. So either way, whether you do RRSP or keep it in the corp, they have individual unique tax implications that's going to affect your after-tax income. And you need to know this, right? Your after-tax income is how much money goes in your jeans that you can spend. So first thing to think about is, what is the tax before you invest. So upfront, corporately versus if you're going to do it through your RRSP. So for your RRSP contribution, the tax is deferred and it lets your corporation deduct that contribution because it'll be paid to you as a salary. So it effectively reduces the taxable income when you put the money into the RRSP. So to contrast that, if you keep the money in the corporation, you have to pay corporate tax on your business income, which is you're either paying the general rate or the small business rate, depending on your total income. So this upfront tax treatment varies depending on whether you invest personally through the RRSP or you keep the money in the corporation. All right, so that's the tax before you put it in. Now we'll talk about the tax on growth while it's invested. And this is super important, right? The tax treatment of your growth while it's invested is significantly different when you have it in your RRSP or inside your corp. The investment in the RRSP gets tax-deferred growth, which means that you don't pay taxes on the gains while it's growing until you take it out, until you withdraw it. In your company, in your corporation, again, different types of income get different types of tax rates. So it depends on what you've invested in. Your interest income is taxed between 46 and 54%, depending on the province. So interest income would be if you lent somebody money or if you had a GIC or something like that. Next, you would talk about dividends from Canadian companies. So you've invested in a Canadian company and they pay you a dividend. That's taxed at 38%. And then you have capital gains, which counts as passive income and it's taxed at 50% of whatever your corporate rate is. So now there have been some changes to how capital gains are taxed with these new rules in the 2024 federal budget. And the capital gains made after these rules went in place in June, they're now taxed with a higher capital gains inclusion, which puts you in the 31 to 36% tax, depending on the province. So now, notably, the corporation also gets a credit, like a refundable dividend tax on hand, which is your RDTOH if you're talking to accountants. So these allow tax credits when your dividends are paid out to shareholders. So we've talked about three big things so far. Number one was to understand your corporate versus your personal tax strategy. Number two is your upfront deductions in your RRSP versus you get no deduction when you're investing in your corporation. And then also, how does the investment get taxed or not taxed as it grows, right? So it gets taxed corporately, but it doesn't get taxed in your RRSP as it grows. Basically what happens when you put the money into the investment and what happens from a tax perspective as you're growing it. We've talked about that now. Now we're going to talk about what happens later when you actually want to take it out and use it to live your life. And then a little bit later in the video, we'll talk about, we'll compare the performance between the two options of putting your money into the RRSP versus keeping it in the corporation, and if your business is paying the general rate or the small business rate. So all of those will make a difference. So the taxation inside whatever the investment vehicle is when you dispose of it, when you sell it, or when you withdraw the money and you need to use it, right? So when the investments are withdrawn or from the RRSP, those funds are fully taxable as ordinary income. Now, conversely, with the corporation, your capital gains are treated as passive income. So you pay tax when you liquidate that, or if it's a fund, if you rebalance, or then you get your personal tax when you take it out. So on your RRSP, those withdrawals are fully taxable as ordinary income whenever you take it out. With your corporate investments, you got more flexibility because your corp can distribute those investments to you, the shareholder, in different forms. So you could have a tax-free capital dividend. So this would be through your capital dividend account or your CDA. You can also get eligible or non-eligible dividends. So these dividends are actually grossed up and they're taxed accordingly with your personal tax rate at 15% if it's a non-eligible dividend, or 38% if it is an eligible dividend. And then also these dividends, they allow you to recover an RDTOH, your refundable dividend tax on hand, which you would have paid before. Again, that's getting in the weeds. That's for your accountant. Make sure your accountant knows what I'm talking about if you don't know what I'm talking about. Now talk about contribution limits and age limits for your RRSP versus in the corporation. This is one of the downsides of investing inside an RRSP, is that you have an annual contribution limit and you'll have a total cumulative limit for your life, depending on how long you've worked. There's also age restrictions, right? So today in 2024, your maximum contribution limit for this year is 18% of your earned income to a maximum of $31,500. So 31,560 if we want to be exact. But your contribution limit is also going to depend on how much you've built up over the years, right? Maybe some years you didn't earn a salary and some years you earned more and you earned less. So you can check your exact available contribution limit in your My CRA account. When you log into your My CRA, which you should definitely have an account, on the left side, there's going to be a section there that you can click on to see what's your total contribution limit available for your RRSP. Another thing too, your RRSP account has to convert to an income stream in the end of the year where you turn 71, regardless if you want to take the money or not. So when you turn 71, you have to take the money, or you have to start taking the money out of your RRSP. And why is that potentially not good? Well, we actually have a few clients like this where they're doing very well now and they don't need the money that's in their RRSP, but because they're coming up on 71, they're forced to take that money out and they're going to be in the highest tax bracket paying 50% tax on that. So say you got $1 million in your RRSP and you don't necessarily need it. Well, as you're going to take it out and you're going to pay 50% tax on that, your $1 million is $500,000 by the time you get to go spend it. So that's one of those things you need to keep track of is, are you over contributing to your RRSP if you're planning on making more money later? The benefit of investing corporately is that you don't have these contribution limits. You also don't have age limits. So this gives you a greater flexibility for long-term investments. So the choice between your RRSP or corporate investing, it ultimately depends on a bunch of things, but a lot of people think about the potential for tax deferral and the after-tax income when you need to actually use the money. And then you'll have factors like the initial tax rate on your active business income. So are you paying general rate? Are you paying small business rate? Are you going to have changes in your personal tax brackets over time, right? Are you going to make more or less money over time? And then also, what are you invested in and what type of income does that produce for you, right? And how long are you investing? The investment duration, this all plays a role when you're figuring out, how to get the maximum after-tax income from your investments, whether that's from your RRSP or from your corporation. So now let's compare the performance between your small business tax rate, if you're paying the general rate or if you're paying small business rate. The article that Sun Life uses, which again, you can link below, they have a guy named Andre. Our boy Andre here, we're gonna use him to illustrate and analyze the situation. Like in the TFSA article, we made a video about the TFSA article a little while ago, so you can click somewhere on the screen to watch that, and it's linked. I'll make sure that it's linked in the description below. So Andre lives in Ontario, and he earns $300,000 and he pays himself his salary. This puts him into the highest tax bracket. And then his corporation is also based in Ontario, and they've made a profit this year of $10,000, a pre-tax surplus at the end of the year. So now let's see what happens. If Andre's corporation pays him this extra $10,000 as a salary, it can deduct the $10,000 from the profit and essentially say that the corporation's income is zero. Then Andre would receive that full $10,000, which he can then put into his RRSP. He can put the whole amount in. So this results in $10,000 being invested in the RRSP, because also Andre won't pay any tax on this money right now because the RRSP deposit is deductible against his personal taxable income. So he's not going to pay tax on that 10 grand right away. The other way, so if Andre keeps the extra 10,000 in the company, the after-tax amount available for him to invest is going to get taxed, and it'll shrink, and it'll depend on his corporation tax rate. So if it's at the small business rate, he's going to pay 12.2% on average. The corporation is going to pay $1,200, and this will leave him with $8,780. And I'll make sure that all these numbers are on the screen. If Andre's company pays the general rate, so this is at 26.5%, the corporation is going to pay $2,650 in tax, and he'll have $7,350 left to invest. So if he invests personally into the RRSP, he starts with the full $10,000 to invest. Then if his corporation invests and they're paying tax at the general rate, they're starting with $7,350. If the corporation is paying a small business rate, then he's starting with $8,780 to invest. So then this corporation would then invest the after-tax amount. And then this will also be subject to your corporate passive investment tax rates, right? So the changes, again, this comes up in the 2024 federal budget. They increase taxes on capital gains, which again will impact your passive income taxation inside that corporation. Now let's make this comparison apples to apples. We're going to say that Andre invests into the same portfolio for all of these scenarios, regardless if it's in the RRSP or if it's in the corp. He's investing in the same thing. It's a simple, balanced portfolio, earns 5% annually with different types of income inside of that, which is interest, dividends, capital gains, and deferred gains inside this portfolio. And then the final analysis is going to focus on the after-tax value of each option to Andre personally. So if he cashes out the RRSP, takes out the funds, or if he sells investments in the corporation and then takes it out of the corporation and pays himself personally. And now here's a graph on the screen that shows the growth over time for both scenarios. So this shows what he gets to keep after paying all the taxes after he sold the investments and withdrawn them. So in the RRSP, he takes it out of the RRSP. In the corporation, he cashes in the investment and then pays it out to himself personally as a salary from the corporation. And then you can see the growth visually in the graph that's here on the screen. So this is the RRSP growth versus if the corp had to pay the small business tax rate every year. In the RRSP scenario, which is the yellow line, if he invests and takes the money out and pays tax in the first year, or after the first year, he's left with $4,879 in his pocket that he can go and spend. If he invests through the corporation and he pays the small business rate, then he pays himself out as a salary, he ends up with $4,836. So you can see in year one, both the RRSP and the corporate investments, they're basically very, very close to each other, right? Like they're within $50. Right? And then again, this slight difference is also due on the upfront taxation that you have on the corporate income, plus the taxation that you have on the corporate income. And so this will reduce the amount available for the investment, and you'll also get taxed on the way up. So we'll use BC, British Columbia, because we're here in Vancouver. We'll use the BC tax rate. So by year 11, by investing in the RRSP, it actually starts to outperform investing in the corporation. And then after year 11, this is where the tax deferred growth inside the RRSP starts to shine. So every year after the corporate investment, it will lag because of the passive investment tax rates on the interest or the dividends or the capital gains, right? So after year 11, the RRSP wins. If he cashes the RRSP out in year 30, he ends up with $20,000 after all the taxes. While if he does the same thing with the corporation, he ends up with about $17,000 after paying it to himself and paying all the taxes. So the gap, that $3,000, shows the advantage of the tax shelter compounding inside the RRSP compared to getting taxed every year on the investments that are inside his corporation. Like that's 13% better inside the RRSP when you cash it out in 30 years. Like we're showing numbers of $10,000 here, but really this adds up to an extra $139,000 if you're starting with $1 million instead of 10 grand, right? And it scales up and down depending on how many zeros we're working with. So the RRSP consistently outpaces the corporate investment over time, and that makes it a better choice for business owners that are looking to maximize a long-term growth. This new chart on the screen right now shows how many years it would take for the RRSP to become a better investment vehicle than the corporation. It's broken down by province. So you can see that in BC, the RRSP starts to beat the corporate investment after 11 years. In Alberta, the RRSP wins after 10 years. And in Ontario, where we also have a ton of clients, the RRSP wins after 11 years, same as BC. Those numbers were all if your company pays tax at the small business rate. When your company pays tax at the general corporate tax rate, the RRSP outperforms way more quickly. So if the company pays tax at the general rate, the RRSPs show a performance advantage like within a year for most provinces and territories. Only a few provinces like BC, New Brunswick, Yukon, and Northwest Territories need more than a year at that top marginal tax bracket, and the maximum is 5 years. So for most business owners, if you're paying at the general rate, then investing in the RRSP is the smarter choice for long-term financial growth. Now, if you're in a lower tax bracket when you withdraw the funds, right? Your personal tax bracket is obviously going to fluctuate over your lifetime as you earn more and less income. And if you expect to be in a lower tax bracket when you withdraw the funds than when you invested, then your time needed for the RRSP to outperform the corporation, that decreases significantly. So the more tax brackets that you can drop, the faster the RRSP outpaces your corporate investment returns. So that makes the RRSP a better choice for long-term savings. And this is a pretty standard assumption when you're investing into an RRSP, that you're going to be making less income in retirement rate, and you're probably going to be in a lower tax bracket, right? Like this is the standard assumption for RRSPs. And then for a lot of people, it works like this. But some people continue to make a high income even in retirement years. So this could be, they're receiving rent from a real estate portfolio, or they've got a big dividend portfolio that spits out dividends every month or every quarter, right? So if you're in a high tax bracket when you withdraw the funds, right, and if your tax bracket keeps going up after you deposit the money, so you're investing today, but you're going to make more money later, and you'll even make more money when you start to take it out, then the time required for the RRSP to outperform significantly goes up. So it's less beneficial. So even in those scenarios, the performance time shown, that acts as an upper limit, right? And you can see that on the chart. So with a sufficient time length, the RRSP generally provides a better after-tax return compared to keeping the money in the corporation. Now, again, it's not about always return. So there's additional factors to consider when you're deciding, are you putting the money in the RRSP or are you keeping it in the corporation, right? What is your investment goal? And are you investing for the short term or the long term? We talked about really long term, almost everything here, but what if it's for the short term? Also, what's the impact on other income tested benefits? So what's the impact on your CPP or your OAS? And then also your grossed up dividends from the corporation can increase your net income, which potentially could reduce retirement benefits, right? Then you have creditor protection. So as business owners, this is important. Your RRSP benefits from federal bankruptcy protection and from creditor protection in most provinces. So while your corporate funds could be exposed, so if you're investing in the corporation, those are potentially available to creditors, there's some legal protection to having funds inside an RRSP. And then you've got your eligible pension income. So RRSP withdrawals, they may qualify as pension income, and then corporate funds would be more subject to TOSI, so the tax on split income rules. And then you have flexibility, right? RRSPs, mandatory withdrawals after age 71. Corporation, no mandatory withdrawals. And then this is also important to consider so that you don't put what's called like too much money into your RRSP and then it could become trapped. And that's where we talked about people that are going to earn more or have higher income later. You'll also need to consider the impact on passive income, right? So as you're accumulating passive income in the corporation, you could lose your small business tax rate and start getting taxed at the general rate. So this is a big one that you need to consider in the calculations because it can cause a significantly higher tax bracket as you switch from small business rate to general rate in the company. And then this is what we do. We're in the insurance world, post-mortem planning. So what happens when you die? When you keep the money inside the corporation, that's more complexity and more cost for the estate plan. And you've got your returnable dividend tax on hand, your RDTOH consideration. So you may need to recoup the RDTOH when you're keeping your funds inside the corporation, right? And again, that's for your accountant. So as a final summary, saving for the future, it requires planning and it requires understanding of your options. There's not just, as a business owner, there's not just a, hey, this is what you should do every time. So RRSPs are specifically designed as a long-term retirement vehicle. So taking money from your corporation to your RRSP often makes sense, especially now that we have these new 2024 federal budget changes, which were designed to make corporate investing less attractive. They don't want you to keep money in the corp. They want you, if you're going to use it, take it out personally and pay them the tax. So ultimately, the decision depends on several factors. It includes your corporate tax rate, so are you doing, and also your personal tax rate today, and your personal tax rate in the future when you're going to withdraw. Also depends when you're going to withdraw. Like, do you need that money in 5 years, 10 years, 30 years? And the answer this year might not be the same answer next year. So today it might make sense to put money into your RRSP, and then in other years it might make more sense to keep the money in the corp. So this is why you want to work with a good financial advisor, because this is what we do and this is what we can help you to figure out. We talk to clients now. We also stay in contact with them throughout the year to keep updated and to adjust this as needed. Like there's no one answer for everybody on this. So if you're a business owner in Canada and you're wondering whether to invest your money inside the RRSP or to keep it inside the company, give us a call and we're happy to help you out. You know, this is what we do all day, every day. This is what we think about, what we dream about. You can reach out to us via our website. We're safepacific.com, and you can send a message through there. Somebody will get back to you within 24 hours on business days, and we'll set up a time to meet and go over your situation. Really, like, what's your specific situation? Now, if you got value from today and you learned anything from today's video, please, can I ask you a favor? Do all the things that the algorithm loves. Tell the robots you love us. So click like, leave a comment if you got a question, share it with somebody, hit subscribe if you're on our YouTube channel. These help a lot. It really helps to get the videos out to more people like you, because this is not information. This is not your standard kind of financial planning information. So thanks a lot for all your help in spreading the word, and I will see you next time.